They promised you 8% returns, steady income, hands-free growth, the kind of pitch that made real estate investment trusts, or REITs, look like a retiree's dream. But now, something's unraveling. Beneath the surface of those glossy yield projections, entire portfolios are cracking under pressure. And the people who believed in the safety of monthly income and property-backed assets, they're watching those promises collapse, one payout at a time. So, what happened, and why are once trusted REITs plunging into freefall? It's not just one thing. It's a combination of rising rates, silent debt risks, and a structural shift in the real estate market that no glossy brochure could have predicted. The warning signs were there, but most people missed them. And if you think this won't affect your retirement plan, you might want to take a closer look, because this story is far from over. It all started with interest rates. When the Federal Reserve began aggressively hiking rates to combat inflation, it didn't just rattle stocks and bonds. It hit real estate like a sledgehammer. REITs, especially those tied to long-term commercial properties, saw their valuations sink almost overnight. Why? Because the entire premise of a REIT's appeal, its juicy dividend yield, suddenly had stiff competition. When Treasury bonds started offering 4%, 5%, even more, investors questioned why they were taking on real estate risk just to earn a few extra basis points. That shift in perception was brutal. Capital began fleeing from REITs, pushing prices down and yields up, not because earnings improved, but because valuations collapsed. And here's where it gets worse. Unlike traditional companies, REITs are legally required to pay out 90% of their taxable income as dividends. So, when property values drop, debt becomes more expensive and operating costs rise, REITs can't just hoard cash or ride it out. They're forced to keep distributing, even if it means bleeding themselves dry. But rising rates were just the first domino to fall. Next came the unraveling of commercial real estate, particularly office buildings and retail spaces. For decades, these sectors were seen as reliable anchors for income-focused REITs. But the shift to remote work wasn't just a pandemic blip, it's turning out to be a structural transformation. Office vacancies have surged in major cities, lease renewals are stalling, and once prized properties are sitting half-empty. And yet, many REITs are still holding these underperforming assets on their books, hoping for a rebound that may never come. Retail hasn't fared much better, with e-commerce continuing to chip away at brick-and-mortar foot traffic. Shopping center REITs are fighting a slow-motion battle against declining relevance. Even tenants that survive are negotiating lower rents or shorter lease terms, making revenue far less predictable. And for REITs, that means cash flow instability and pressure to sell off assets, often at a loss. What was once a dependable stream of income is now a patchwork of uncertainty. But we haven't even touched on the financial weapon hiding beneath the surface, the debt. Debt has always been part of the REIT game, but in 2025, it's become a ticking time bomb. When interest rates were near zero, it made sense to borrow heavily to acquire properties and expand aggressively. But now, that debt is starting to mature, and the refinancing terms look nothing like they did 5 years ago. Some REITs that locked in low-cost loans are now being forced to roll them over at double or even triple the interest rate. That's not just a hit to profitability, it's a fundamental threat to survival. What makes it worse is that many of these REITs aren't just modestly leveraged, they're loaded up to the ceiling. In a rising rate environment, those interest payments start swallowing up cash flow, leaving little room for maintenance, improvements, or even dividend coverage. And if they can't maintain their payouts, investors panic. Stock prices fall. The cost of capital rises. It becomes a downward spiral that's nearly impossible to escape. And yet, most investors don't see it coming because all they've ever looked at is that attractive dividend yield on the surface. But the rot runs deeper than that. One reason so many investors miss the warning signs is because of how deceptively diversified these REITs appeared. At first glance, it looks like a safety net, dozens or even hundreds of properties spread across regions and sectors. But take a closer look, and you'll see something else: concentrated exposure to risky subsectors. Many REITs claiming diversification are heavily tilted toward office parks, aging retail centers, or speculative development projects in overbuilt regions. Some of the worst-hit funds are overly reliant on tenants in industries that are themselves struggling, like co-working companies, mid-tier department stores, or small businesses that barely weathered the last recession. And once those tenants break leases or default, cash flow dries up fast. What's left is a facade of stability, covering a portfolio that's far more fragile than it appears. That false sense of security is exactly how retirees get blindsided. But it's not just about what these REITs hold. It's also about what they're forced to do when the money runs thin. REITs are legally required to distribute at least 90% of their taxable income to shareholders. It's one of the features that makes them so attractive, steady, predictable income. But in tough times, that very rule can become a trap. When revenues drop and expenses climb, REITs can't simply tighten their belts and hoard cash. They still have to make those payouts, even if it means borrowing more money or selling off valuable properties just to stay afloat. Some REITs have already started slashing dividends quietly and without much warning. Others are disguising unsustainable payouts by dipping into capital reserves or issuing new shares, moves that dilute existing shareholders and chip away at long-term value. The problem isn't just that returns are falling. It's that the whole income machine, the one retirees counted on for stability, is built on assumptions that no longer hold up. And as cash flow tightens, these funds become more exposed to the one danger investors fear most: being unable to get their money out when they need it most. When markets are calm, liquidity isn't something most investors think about, but when fear sets in, and it always does eventually, suddenly everyone wants out at once. That's when the dark side of REIT investing shows up. Unlike stocks in major companies, some REITs, especially non-traded or thinly traded ones, don't have deep ready markets. That means if you want to sell, you might not find a buyer. Or worse, you'll be forced to accept a steep discount just to exit. In volatile environments, bid-ask spreads widen, trading volume dries up, and those once steady dividend checks can't make up for the gut punch of a 20%, 30%, or even 40% capital loss. And if the REIT owns properties that are hard to value, like distressed office towers or outdated retail centers, investors could be stuck holding something that's not just illiquid, but actively deteriorating. By the time the broader market catches on, the damage is often done. But the real concern isn't just about liquidity, it's what widespread panic could trigger next. The final, and perhaps most dangerous, risk is the domino effect. When a few REITs start to struggle, it doesn't stay isolated. Fear spreads fast, especially in retirement portfolios where stability is everything. As investors begin pulling their money, even well-managed REITs can get caught in the fallout. Prices drop, not because the fundamentals collapsed, but because the herd is running for the exits. That's when panic selling kicks in, dragging down funds that were, until then, relatively solid. But it gets worse. As REIT share prices fall, it becomes harder for these companies to raise capital. That limits their ability to invest, refinance, or even maintain the properties they already own. And that decay from falling valuations to crumbling buildings can start feeding on itself. What began as a quiet erosion of investor confidence can explode into a full-blown sector meltdown. The retirees who once saw REITs as a safe haven, many are now realizing they were standing on a cliff's edge. And as that realization sets in, the question becomes, is there still time to step back before it's too late? What started as a promise of stable income and 8% returns has unraveled into something far more dangerous, an illusion of safety that's cracking under pressure. REITs weren't supposed to fall apart. They were marketed as the retirement-friendly middle ground between risk and reward. But rising interest rates, collapsing commercial demand, over-leveraged portfolios, and panicked investor exits have exposed a hard truth. Many of these funds were never built to withstand this kind of storm. The scariest part? Most investors didn't see it coming. They focused on the yield, not the structure. They trusted the brand, not the balance sheet. And now, as portfolios shrink and dividends vanish, the wake-up call is loud and painful. But it doesn't have to be the end of the story. This is a moment to reassess, not just REITs, but the entire strategy behind your retirement income. Blind trust in any asset, no matter how polished the pitch, can be costly. Because what matters now isn't what the fund promised you years ago, it's how well it can survive the next 5. And in today's market, survival isn't guaranteed. It's earned by being informed, nimble, and unafraid to question the assumptions everyone else blindly accepted.